All right, we are live. Well, hello guys. Welcome to another episode of Paris and Bazcast. This year, it is all about COVID-19 and its impact on property and finance, and property management, the three services we provide at Paris and Baz. Today, we are joined by Arjun Paliwal. Hello.
Yeah. Arjun, thank you for joining us today. How are you doing?
Yeah. So Arjun, good. Yeah, I think just double check the mic. I think if you just speak once again.
Yep. Hello. You can hear me okay?
Sounds good. Yep. Excellent. So Arjun's joining us from InvestorKit, a renowned buyer's agent, and we've been working with him for the last number of years, and I've had some success stories to share there as well. Yep. So Arjun's going to be talking to us about investing during COVID-19 and how you can minimize risk of investing. So Arjun, what have you seen with your clients investing during this time, this pandemic?
Yes.
What are some key trends?
So I guess the first thing is, firstly, we've been pretty active. We're buying anywhere between 6 to 10 properties a month, and regularly purchasing across different parts of the country, and that volume hasn't slowed much at all during COVID. And I guess the key thing is, when we are purchasing across the country, the first thing that everyone needs to know is that Australia is a market of many markets. And when we think of, all right, there's different cities, even that's too broad. Different suburbs, even that's too broad. I'd say more so different streets and neighborhoods. You know it more than anyone else. You sell across such diverse backgrounds of Norwest, West, and different parts of Sydney. And what I've noticed is that just from where I'm right now in the family home in Glenwood, and where you guys are at, there's hundreds of thousands of dollars in differences, just a 5-minute drive between us two in property price. So I think that is a clear sign that it starts off with not everything's the same, but yeah, in terms of the trends wise activity for us, it's still quite leveled. But yeah, I definitely that's what I'm seeing at the moment as a first point.
Very good. So what strategies are you using to minimize risk when you're investing in the current environment?
Yeah, I think minimizing risk, that's a big thing that needs to be on everyone's mind. And when I think of, strategies, it's important to firstly look at the data. And when we're looking at data, too many people are basing it off just the data right now. And because it's changing so quickly, there's so many things that are trying to put a floor on prices, stimulus, and all this sort of stuff, that we are forgetting that we need to firstly start off by looking at data pre-COVID, because when we look at pre-COVID data, that gives us that sort of step back and get a soak in of a bigger picture of stuff. And from there, we've started to go, okay, where were the markets that were doing things pre-COVID? Because remember, this isn't a financial crisis. This is anything that's stemming from finance. It starts with a health issue that's turned into a productivity crisis, which has finance impacts. So if you look at it from that perspective, you need to look at pre-COVID data to begin with. Now, once we start doing that, that's the first part of our strategy. But then the second part of our strategy is, even the locations that we liked pre-COVID, today we are seeing 3 different types of activities amongst the same locations that we liked. One location that we liked pre-COVID is now showing decline. One location that we liked pre-COVID is now showing stability. And another location that we liked pre-COVID is surprisingly still growing, even during COVID. And so from that's where this next sort of, what do you feel okay with, comes up. Are you trying to target stability, where you feel like you can still invest and go, hey, Anmol, good dev, like imagine owning a property where you've got stability during one of the most unprecedented times in the history of the world. Like how do you feel, right? As an investor, you feel pretty good. And personally speaking, I purchased a property just a couple of weeks ago, and I settled in a couple of weeks for myself. My wife and I, we purchased our 11th property together, and it was in Bendigo. And that was one of the markets that is seeing stability from a price sense. For those wondering, what did the professional negotiator do during this, crazy market? Well, guess what? The property was listed for 380 that I purchased, and I bought it for 380. So we're not talking markets dropping 10, 15%. We're talking a well-listed property. And as you know, from sales campaigns, they can be slightly overlisted. You get it at the right point, you get a discount, you feel on top of the moon, but you probably bought it for the right amount.
Yeah.
Then, slightly under, or, depending on people's opinions that range on property, and you don't want to pay over it, but that slightly over could be the right amount. And then there's properties that are perfectly presented, listed at the right amount. And you might think, well, I've got a low ball because that's how I negotiate. And someone else picks up the deal because they see the value sitting there.
Yeah.
So
Careful.
and so, my unique purchase, it was firstly presented to one client of ours, and that client, just due to their finance reasons, couldn't make it work. Then I presented it to a second client. They actually exchanged on the property. And when they exchanged on the property, COVID had hit their business. And so they had to back out on the finance clause. And here I am, I'm like, this is such a good property. Like, my first client just missed out. My second client bought it, actually bought it. And then they missed out. I'm like, looking at my wife, she's looking at me. I'm like, let's just do it. Like, we've given our clients the best opportunity. So that itself should give some level of confidence to people that not all markets move the same. And we chase stability. It's rented to a tenant. The rental yield's high fours. We're getting good rent, 380K purchase price, walking distance from Bendigo CBD, renovated 1940s bungalow, just beautiful character to it. And we've got that in our portfolio with a property 2 doors down that's completely renovated on the same land size, and it's sold for, I think it was valued for almost 200K more, right? So, that itself speaks that long term that we're chasing. But I think coming back to the strategy, this is where an investor needs to decide, are you looking for stability? Or are you happy with the market pre-COVID and you think that, okay, well, there's some distress happening here, because there will be some locations, and I want to go hard on that distress? Or are you looking at those markets where there's a little bit of growth happening? And one of those examples is, the northeast part of Adelaide. We've seen vacancy rates as down as 0.5% in some suburbs, owner-occupier percentage of upwards of 85%, very small level of renters. The rent in the last quarter has risen by 5% in some of these locations in the northeast. Rental, you could look at a comparable sales analysis and be actually hurting your profits, because the comparable rents could be 350 to 380, but really you should be renting it for 380 to 400 based on how tight the rates are of vacancy and how many applications people are coming in. Like, you two are in the property management world as well, and you understand that it's not normal in the first week in a part of Adelaide to get 4 applications, like in COVID too. So that has been a sign for us to increase rents, and we're seeing properties that were 360 to 380 comparables, and we're getting 390 to 410 rents. And then on top of that, you're getting asking price rising by a couple of % over the month of April and up to the second week of May. So vendors are asking for more as well. So there are markets that are showing different things. And I think as an investor, once you combine pre-COVID, then you decide, all right, off the back of these, what am I seeing? Stability, decline, as well as, growth in some pockets. Then you have to feel like, okay, the next part is employment. What type of employment is sitting there? And what type of rental market are we operating in? And by doing that, that's the 3-phase approach we're taking, from a pre-COVID data, during COVID approach, and then lastly, the rental strategy, and just making sure you feel comfortable from that end.
Yeah. And what is driving that sort of growth in Adelaide? I mean, for that sort of level of demand, is it what's happening there? Like, obviously they're getting some good stimulus there, I guess, so to speak, or JobKeeper, or keeping their jobs. So what exactly is driving that?
Yeah. So firstly, it's definitely in pockets of Adelaide. It's not widespread.
Yeah.
But I guess when you look at Adelaide in particular, that price range, if you imagine 350 to 400K, today's repayments on it, someone on JobKeeper could maintain a mortgage and or rent, and somewhat of a lifestyle, even with JobKeeper payments, no job due to COVID, and not see themselves have to sell down their house or rush to it, right? Phase 2 is if you put an investor in front of you and you put a buyer in front of you who owns the property, owner occupied, the owner occupied is going to be least likely to sell if they had to. they've invested time, love, energy. They would want to stay in that property, hold it as long as possible. It's their home, right? Whereas the investor may not have that same emotional connection with it, and they may flog it off to free up cash. 90% of some of these suburbs, 85% are owner occupier. So 8.5, out of the 10 stock, like every 10 properties, 8.58 properties are people's homes.
Yeah.
And, on top of that, 30% of some of these suburbs are owned outright. When you're talking 30% owned outright, overall 80% plus an owner occupier, you're talking rents and mortgages that are covered by JobKeeper. The last thing is, when people see properties this cheap, what do you think? You go very low socio, very low income, but then income ratios are actually 25% or below for some of these suburbs. Now, when we call 30% of rent or mortgage repayment to household income as affordable, when you're talking 22 to 25, people are not there with less incomes on cheaper properties. They just are sitting in affordable locations that they want to live in, and they haven't gone into a frenzy to make these unaffordable. But if people wanted to have, a competition between each other to really fight for some properties, they have the income capacity where they're 7-8% below a 30% threshold to go.
So they're comfortable basically at the end of the day with the city.
Right? And you've got 14 days straight with no COVID cases in SA. COVID cases the last 14 days. Confidence, stability. And remember, over the last 1 year, we've seen Sydney and Melbourne markets recover amazingly, and it's been really good to see.
Yeah.
But when someone is looking at a 1 year statistic, you're looking at 13-14% recovery in some of these markets. They're confusing recovery with growth. Growth is 2020, 2021, 2022, once we get past peak, and then you look at the growth rates beyond that. 13-14% is recovery. Whereas markets like Adelaide, Brisbane, Hobart, Canberra, their growth is actual growth. So even if it might be a third of the percentage, it's a new peak. So if we're talking a new peak that's being achieved in Adelaide, even if it's 0.2% growth, it's 0.2 on top of peak. We're not talking a recovery. So I think that confidence of the COVID environment, the fact that the affordability, the high ownership outright, the high owner occupier, the stimulus, the government's played a huge part there. All of those factors, when you combine that with little available land in some of these suburbs, if you're fully built out, what supply is coming in that's going to shake it up. So again, these are just trends that we're seeing in select pockets. But I think when you think of that, it just shows that when you're buying, there are parts where you'll get stability enough for me to jump in and buy in the middle of a crazy crisis. So
And what did you find, obviously, when and what we have seen from buyers that are looking for owner occupier properties, for example, if we recap the last sort of 6 to 8 weeks, at the beginning there was a lot of holding your breath sort of scenario where no one knew what was going to happen next in terms of lockdown, in terms of being able to see new properties. So there was that sort of a lag, and then what we've seen in the last 2 weeks specifically is that sort of renewed interest. The level of inquiries have come through, they have increased. And now, for example, for this weekend onwards, there's going to be open homes and auctions back. So I think it's just going to renew that sort of consumer sentiment. From your database of buyers or from your clients, the trend that you saw when the news broke down of this is what's happening, was there sort of an increased activity for, okay, this is going to be a great time to buy, let's see what's out there? Or were they sort of cautious as well, saying, well, let's just wait to see what happens? So was that an opportunistic time in their mind, or were they cautious to buy?
Yeah, so I've always categorized my buyers into 3 buckets. One bucket is an opportunistic buyer who may have been asleep in the past, and now they just suddenly wake up and they want to just do stuff. That bucket has picked up. Within that bucket, there's 2 types of opportunistic buyers. There's one who goes, even a 5% or 10% below peak is a good deal. But then there's another opportunistic buyer who goes, everything should be 30% off.
We're talking about it.
You should be Kmart, right? Target, this is 30% off. This is up to 50% off. But sadly, their expectations are going to be, popped. It's not really to that stage. No matter, I'm surveying markets across the country, and we've secured many distressed deals, sometimes up to 10 to 12%, but 20, 30, 40, you're kidding yourself. Second bucket is the investor that goes, I'm really focused on my future wealth creation. I know from World War I to World War II to every pandemic, crisis, health issue that you can map out on a map, the line is still going to a sideways direction up. It's a mountain, it's a step, whatever view, it's climbing. It's not a valley. It's not a slope falling down. And so I think they have that sense of direction to go, whatever it may be, long-term wealth creation is my goal, but I need a few extra boxes ticked. And usually those extra boxes come down to rents, because holding an asset is more important than anything, right?
Yeah.
And the third and final bucket is I'll only invest when the stars are aligned, the skies are clear, and I can just absolutely tick every single box possible. And those clients are not here in buying today.
Yeah.
So we have to be honest to ourselves to say they're not buying, they're out. I used to have all three. I don't have three, but I'm working with these two buckets here. And I think that's naturally reflecting in the lower listing in sales and volumes and transactions. That's reflecting in higher days on market, because you've got those star aligned, clear skies, everything's good people. They're not here. They're not buying, they're not selling, they're not doing anything.
Yeah.
True. And when people look at the bottom of the market, more often than not, they've already missed the bottom of the market, because you will not know until you've experienced it yourself.
Yeah, so that's an interesting point. I mean, like, I remember I used to have a questionnaire that I used to go through with clients who wanted to buy in declining markets, because we've executed purchases in declining markets like Sydney between 2017 and 2019. And then as well as, your increasing or stable markets. And these questionnaires hover around people's cash flow expectations. What happens if prices went down further after you bought? How would you feel? What would you react? Would you come to, slit my throat, or would you be like, okay, it happens as property? The next thing is, what happens if certain repairs come up, certain vacancies come up? I test them in these scenarios to see what type of responses they give. And then off the back of those responses, I then really base a judgment call to go, no, look, it doesn't matter what decline or bottom's coming up, you should not be buying here. You're not the type of person to buy here because it doesn't fit your characteristics. You maybe shout out at a barbecue, you got this epic deal, but the next day you're going home crying, I hope it doesn't go down further. Like, that emotional roller coaster is not fit for you. For those people, it doesn't matter if it's the bottom or not. We're not buying for you in these locations. We don't want that sort of impact to you emotionally and personally. But on the other side, there are people who've responded to me. One of the mutual clients we had, I asked them this question during a month before election, 2 months before election. There's a lot of stuff happening. I'd suggest we don't buy in Sydney for these reasons. How do you feel about that? No, I want to buy in Sydney. Okay, cool. That gave me my part one of the questionnaire. They're quite firm. Part two was, it goes down another 10%. What do you do? Their response, I'll buy another one, because I'm just going to hedge my bets to buy another lower point, and it captures that loss. I go, okay, part three, you're getting low yield. The cash flow isn't as good as what I could get you in Brisbane or Adelaide. How do you feel about that? Well, I'm in a different scenario. I'm well buffered. I'm able to borrow beyond this next purchase, perhaps for 3 or 4 more purchases. I feel okay making that call. But I'm in the industry and I want to buy something at this point. So alongside many other questions, they gave that comfort. And, we didn't buy at the bottom. We bought around April, May. It was far lower than it was in 2017 March, peak price in Sydney. An asset was around maybe 660, 675, 665 at peak in value. Days on market, about 10 months, which is crazy. An asset on 10 months on market. A tenant had trashed the property before. And, anything that you could think of that you weren't going to like, or reasons to not buy a property, that was there on this property, right? But they trusted us. We bought that property for 574 during the decline. So massive, 100K off peak point. It went down further, in my opinion, towards the tail end of the year, probably down to 550. But then I'd say around July, August, September, we started to see some strong recovery points in Sydney. And so, that bottom of the market going down even more to a new bottom, that could have shocked people, right? Then we revalued the property 2 weeks ago, and we got close to 650K in valuation, almost 14% above since buying. So Gurdev, to your point, there'll never be a bottom.
That's right.
It's just about that emotion of the person. We can all talk about getting these great deals and all that sort of stuff, but that person, that character, that emotion, that stability, that needs to be there when executing these type of deals. Otherwise, it's dangerous for people who are trying to do that.
Property is a long-term game anyway, in any sense. So,
Yeah.
Mm.
There you go.
So there you go.
And what other good buying are you seeing? So obviously we've touched on SA, but anything else? What about locally here? What's the Sydney market in your opinion like?
Yeah, so I think from a Sydney market perspective, good buying can be defined in a couple of ways, right?
Mm.
I'll talk about, say apartments, townhouses. I'll talk about them a little bit.
Yeah.
I'll talk about, some say premium markets, and then even just, some more affordable markets, right? So right now, I think the key thing, if people are going, well, locally, I'm in Sydney, I want to try and catch a really good deal. Maybe I'm a first home buyer. Maybe I'm trying to just get the best price possible. And yes, I know it's all about the long term, but I know there's some opportunity to get the best price possible. I would be looking at inner city, near the CBD type apartments, high-rise buildings as a first home buyer, thinking inner west, that sort of region. And the reason why I talk particularly about that region in the inner west is, we've got some of the highest proportion at an LGA council level of people in hospitality, retail, and accommodation jobs and services in that council level, in the country.
Yeah.
Like you might think, what about all the beautiful, Queensland locations, tourism and all that sort of stuff? Inner West Sydney has some of the highest people populated from those type of impacted jobs, right? Number two, a lot of the Sydney CBD Council, alongside Brisbane CBD Council and Melbourne CBD Council, they bring on some of the highest overseas migration, right? Now, 63% is a significant makeup of the population growth, which actually came from net overseas migration over the year ending September 2019. That was 232,000 people, right? From the net overseas migration. Sure, there's going to be a slowdown in that part for a couple of reasons. One is the airports, right? But number two is it might not be the full impact because net overseas migration also considers the number of people leaving. Right? So they're staying; they're not going anywhere. You're not going to catch a flight to New York or anything during this time, right?
Yeah.
However, whilst it's hard to talk about that sort of net number because there's people staying, people not coming, the important factor is there was growth, which means more people were coming in than leaving, and growth is impacted. So when you've got apartments, townhouses, where LGA-wise, Sydney CBD, Brisbane CBD, Melbourne CBD are the top three councils for overseas migrants coming in terms of staying in and migrating to those regions, we're going to see then the highest makeup of properties being townhouses and apartments and high-rise buildings in those councils. They're going to be usually the people who have the highest amount of investors. Approximately 60% plus of these assets are investor owned. And so when you've got a few things coming together, migration stops, building is carrying on, Airbnbs are turning to normal listings. 6 out of every 10 people who own some of these apartments are investors. Then you've got locations where people are expecting overseas people to come and rent. Because remember, you're not going to come from overseas and your first goal is, I'm in Australia, I'm going to buy a place.
Yeah.
Rent, right?
I moved close to.
There you go. I moved from New Zealand 10 years ago. I did not come here and go, I'm going to take over the real estate market and buy all of Australia. I said, hey, I just want to check out a cool place to eat, a cool place to, shop and rent. So if I'm a Sydney local investor, you want to snatch up a deal, you're going to find your deals there. That's where the deals are going to be. Investor stock that cannot handle rental in the inner west and those Sydney regions where they're not able to get tenant, vacancies rising. I'm seeing rise week on week trends. Days on market for rental listings are rising. That's where your discounts are. From a premium market, I'm seeing two very different things. Premium markets are very much unique in the fact that sometimes they can be volatile because they're sentiment driven. They have the biggest gains. They have some of the biggest losses in one go. But at the same time, the ability to hold some of these assets with the affluence of some of these owners, it results in a lot of suppressed stock. So in markets where there'd be a bit more transactions going, you don't get that. And so the fact that some stock is very suppressed, you've got, even though you've got less buyers, you also got less properties for sale. And sometimes you'll have this effect where not much really changes because you've now got that change.
Yeah.
And you can sort of see that in some of your premium pockets of the Northwest Sydney. Is it like this sort of stalemate where you've got less sellers coming on?
Yeah, who doesn't need to sell? They're just saying, look, we'll just hold back. Let's just ride this out and then we'll hit the market. So that's been a bit of the sentiment as well.
I've just got a question from Mega asking, would an apartment appreciate on the same rate as an independent house? Sorry, just moved from Melbourne and need a clarity if apartment is a good option from investment point of view. Now that's another, that is a question that we're being asked a lot, the investment of apartments versus houses. What is your opinion on that?
Okay, so investment's the key word you've used. And so from that perspective, that's where I'd give a straight answer to go. At this moment of time, and historically, it's been inferior. So the house has been the winner among. Firstly, we have to look at why people go to apartments. People go to apartment buying not because they were keen on an apartment because of its location. They went to an apartment buying because they liked the location and they couldn't afford the house.
Yeah.
So that way of buying a property is the first flaw. You're going to buy a property only because you can't afford that better asset you want in the location. So you'll settle for B.
Yeah.
Whereas, there are locations where over the last 20 years, like I believe REA released an article over the last, I think, 2 days, realestate.com.au, and Oran Park was one of the top performing suburbs over the last 2 decades in Sydney. We're not talking blue chip. We're not talking in suburbs. We're not talking, North Sydney. We're talking Oran Park, far southwest, and so forth, right? Sure, some of that pricing growth is impacted because it's median level, and a lot of the new builds would have shaped that median change.
Yeah.
But there are genuine people who would have had properties for take less than 100 grand in part of St. Mary's in the 90s, who sold it for over $1 million on R3 zone properties on over 1,000 square meters of land, right? That's 11 times your money in 20 years. Yeah. So what I would say firstly is that, houses, I feel that are a superior asset type as of right now from supply control, from, a few other factors around the land that appreciates in value. Yes, a unit sits on a land, it's apportioned. Yeah. As you go up and up and up into the sky, that apportion starts getting smaller and smaller, right? Yeah. And then, of course, in a house and land component, if I see a built out suburb, the only way you're going to build more is either knock down and rebuild and build more newer ones. And that gap between new and old gets greater. And if that gap is greater, then people will start realizing it's too expensive to buy those new ones. They'll start buying the old ones and they gap gets smaller again. And then it gets greater again and smaller again. Yeah. Or someone's going to rezone it and build, lots of apartments, and then your land value can pick up again. So that's always shown over time. But the thing that people don't realize is because of this unique environment, if apartments take that much of a hit, which I feel that they will, then just from that whole buying timing that we're in this window of, that may enable your first few years of performance. Once we open up airports, open up things again, we have a lag in supply because there's not going to be much new projects going on. There's been a huge drop in new approvals. As a result, that may make the apartments play a bit of catch up where there's a big gap between houses and apartments. So if you're buying in a suburb where there's not too much of a price gap between the two, then what catch up are we going to play when you could pay that couple hundred K more, you might be in a house. Yeah. But if you're starting to see distress, overseas migration impacted areas, retail accommodation, hospitality, high nodes of employment, supply coming on, and certain councils, then you may be able to get that apartment. But right now, it just doesn't make sense because to buy that 400-500K, 600K Sydney, Melbourne apartment, we're seeing some amazing house deals in markets like Brisbane, Adelaide for the equivalent in that location that you wanted. But so that's my thoughts on that one.
Of course. So what about the likes of, because one of the areas that we feel, has a lot of potential, being the location that it's in, the Westmead precinct, being close to the medical precinct there. There are properties that are, on one side, which is closer to the development of the light rail that's happening. So there's potential for them to be knocked down, rebuilt. So there's apartments there. Then there's on the other side, which is newer apartments. But again, that location allows itself to be a good opportunity because medicals are always going to be in demand from a perspective of tenants. We've leased out properties in that area where a lot of people that are wanting to live there are living close to work, which they are in the medical profession. What are your thoughts on buying in those locations, being close to the essential services areas of Sydney?
Yeah, cool. So the cool thing is I've got some personal history with Westmead.
Okay.
From New Zealand to Australia, Westmead was the first suburb I migrated to.
Yeah.
Region, lived in there for some time, and very familiar with the short walk from Westmead to Parramatta as well, which is amazing.
Yeah.
Very central. Yeah.
So I think that there will be waves of opportunistic moments that make that a good investment over time. Now, to give you some context, what I've seen in some apartment buying is, there's two types of things that can start up. Firstly is your pre-market, off the plan buying, where it's sort of, high sort of hype. And you're in some projects, like in some of the Epping areas, you go back a few years, many investors who I'm, close friends with, in some of the Asian communities, bought many properties in that region. And, they had some fantastic off the plan buying that really ended up being great prices, right? But then you've got the opposite side of off the plan where we're pricing for this future that we hope to happen and it doesn't happen, right? So I think that's the first wave of, where good things and bad things can be made. But the second thing is, when apartments come up at the start with all the hope of the different projects, sometimes they can be priced according to that hope and all the different things that come up.
Yeah.
There might be a high take up of buying, but then what happens is one developer sells the dream. More developers feel like because of the success that they see, buy certain land, they can also sell the dream. And as we know, there's not just the one or two developers in Sydney. We're full of very ambitious and capable developers. And come in and build different stock. And all of a sudden, you get a high level of supply. Now, very common that sometimes that supply is met equally with demand, and you just don't see that shake up and you don't see that negative impact. But, there could be some significant supply coming in where from that you might see more and more projects go up. And I think that's that point of buying in Westmead and those sort of times where you see a substantial amount of stock in the pipeline. It may be now, and it may be that pricing. I'm not so sure. I haven't done too much of a deep dive enough to call it, but I just know that where I've seen the most opportunistic and well bought apartment timings is being that moment where there has been a significant amount of supply on there, and it's coming towards a slowing down in new building approvals, and you're able to buy at some competitive prices because you just got so much choice.
Yes.
So there's abundance of supply at the moment as well, and we're seeing values coming lower as well, especially off the plan that are settling now. Some customers, they bought 100 to 200k above the bank valuation.
I think that kind of point is where you have to be mindful of, and I think at that, when I think of, do you want to be caught amongst that point of when it's right or wrong? I mean, it could be the perfect point. You could buy in low supply, and then two people just shook hands down the road to acquire 4 lots and go 20 floors in the sky. Like, what do you do then? So I feel like, yes, there is growth. Yes, there is promise ahead. That region is going to transform. I've seen it happen in front of my eyes, and people, are going to have growth through that long-term hold, in my opinion. But I feel that, you have to weigh up opportunity cost versus growth potential. And to me, opportunity cost is going, what if I bought that house over here in another market that I'm seeing clear signals now versus this could transform, see what happens. So there's money to be made, but at the same time, there's opportunity costs that could be impacting from a house in a different location.
Yeah.
You have to be careful in your strategy you use.
Yeah. There you go. And I guess the main strategy to minimize risk when investing is speak to a buyer's agent. You got to have the plug there, hey?
I've got one other thing I think that people will find useful, something that we're doing from the rental perspective, guys. And I think from the rental perspective, that is very important to people during this time.
Mm-hmm.
So what we're doing is creating a bit of a hierarchy of properties we're targeting. So target number one, and anyone can use this hierarchy. Target number one is existing tenanted properties, right? There are landlords out there who want to free up cash. If you've got relationships with agents, you're going to be in a position where they'll offer you properties off market. And we're looking at a lot of off market property at this stage. And so with that, people, as you know, Anmol and Gurdev, don't usually go to market when they've got long leases on a tenanted property. You've wiped out most of the owner-occupier market, right? So what they want to do is they are now looking to sell pre-market, or they're taking their chances just because they have to sell and they're putting it online. So that's the first part. Buyers agents open up that relationship point, which is what we do, is that sort of close relationship between the other side. But from that's part one, targeting assets. And then you can also have that discussion around what's the tenant's current position and so forth. Ledger request, industry impact, that part. Two is, okay, it's not tenanted. We've had 35% of properties under a vendor rent back scenario for purchases made during the month of April. So almost 3.5, pretty much 3.5 out of 10 properties, are vendor rent back. And for those who aren't sure what that means, it's basically going, hey, Anmol, I'll buy this property off you, but do you mind staying there for the next 3, 6, or 12 months?
Yeah.
As part of that rent back, we're having a discussion that the vendors are actually open to share their industry, their work position, even before we've purchased the property. They're happy to share that, just because there's that sort of good back and forth, healthy discussion, not trying to lowball everything because it's COVID, and just having a two-way chat. The third part, if we're not getting a vendor rent back scenario, is the fact that we're looking at options to have longer settlements. What might be a 30-day settlement, I'm going, hey, Gurdev, could we have a 42 or a 60-day settlement? On the contract, I'd like to negotiate a clause that says once we're in unconditional and have passed the cooling off and or finance clause periods, I would like to list and advertise the property for rent, holding this many inspections per week at these given times. Is that agreed with you? We get that into the contract for sale, which our lawyer and legal relationships are putting in very tactfully, and the vendors agents are really helpful in that understanding of it. Then what we're happening is we're getting a whole listing campaign out for many weeks, even before we settle. And then from there, we're able to settle with income day one. And again, still selecting tenants that are in the best position to pay that rent. Then the fourth and final part is if we don't get it, then obviously we just do the normal case, which is rent out a property after it's settled. Now, during this whole point, we've put sliding scales on our data. I believe that under 1% is a very, very tight vacancy rate. Like I'm talking rental crisis level, people hopping on top of each other, applications flying at you, kind of like, you just like, paparazzi, you come out to paparazzi and you've got people, that's 1%, right?
Yeah.
Then you've got 1 to 1.5, which is close. It's extremely tight, but it's not red carpet, autographs flying everywhere as applications tight. Then you've got 1.5 to 2, which I feel is still somewhat tight, but not extremely in that 1 to 1.5. Then you've got 2 to 2.5, which is cautious or balanced, I'd say. And then 2.5 to 3, I call cautious heading into danger. Other people have different stats that they look at. 3 is the balance point. This is just my sort of view of it. What we're doing with these is we're applying a sliding scale and changing that. 0 to 1 is no longer very, very tight to us. We're calling that extremely tight, not very, very autograph, red carpet tight. We're then talking 1.5, 1 equals 1.5. We're just giving those expectations to be tighter. We're targeting areas with less rental population. So in the month of April, we're looking at seasonality trends of the year before. Oh, wait, there were this many rentals. We're now at this many. Okay, it's in line with seasonality trends. Or hold on a minute, it's jumped real high up and it's not to do with COVID. We see it just jump up during the months of March and April. So we just want to be mindful of that. So what you can do is just really double down on the data during this period on rental, apply some of these buying strategies, look at data pre-COVID, and then look at COVID as a way where you look outside your backyard, so you don't have to go and buy an apartment just because you know that location. Look outside your backyard and look for either markets showing stability. There are some showing growth, and there's some, obviously, distressed deals can be picked up.
Absolutely.
Yeah,
so look, I guess the key is to know your numbers. I think that's what and know the fact that it is a long-term game, and understand what your main overall objective is from the investment, so that you are making the right decisions. Whether it is COVID related or not, but it is past that interim period of COVID and where that goes.
Yeah, basically making a well informed and educated decision.
Yeah.
And I think on a final note, guys, I guess from my perspective, heading into this time, if all of this didn't happen, going back a few years, I talked about dwelling deficiencies. It sounds crazy. But we were heading towards dwelling deficiencies, and building approvals had dropped off in 25% in some regions. Country level, we're talking double-digit drops over the last year. We're talking many of our peak completions happening and then being soaked up. And we're talking about strong population growth across the country too. So imagine, just a couple of months ago, we were on track to head towards a late 2020 into 2021 dwelling deficiency where we'd be undersupplied across most markets. Now you've got a period where we're probably going to have a further drop in building approvals, although it stayed stable recent month. I feel it's going to have a further drop because developer confidence is another thing that reduces. Like if you've got low transactions, how as a developer are you going to feel comfortable throwing out 300 units, 200 units? Like you're not going to do that. And so if we're going to see more decline, it's two parts to the story. One is jobs get impacted, construction industry, not good to see. But the other part is, how do we fit that population once airports open? Whether it's a year from now, 2 years from now, we're just kicking the can down the road for undersupply. It's going to hit us at some point.
Yeah.
So I think if you are in an opportunity to purchase property and you are comfortable from buffers, you consider the strategies I've discussed to protect your rental, look at data in different ways and look across the country, targeting houses or what it may be for your scenario. I think you may put yourself in a position where, whether it's 2021, because we don't get into airports opening up then, or whether it's 2022, at some point, we can't just keep kicking that dwelling deficiency down the road, because people love Australia and people are about to love Australia a whole lot more because of the way we're handling COVID. And if we don't go through the second wave, and if we don't go through some deep impacts and we can sustainably slowly unlock this all, just imagine, we're all from migrant backgrounds. How do you feel when you're trying to raise your family, you're looking abroad, you see 10 countries you can choose from, and one country has just shot the lights out for how they're handling the scenario, they're protecting their people. Do you go be one of their people? You no doubt will, right? And I wanted to be one of the people. You guys did. I think we really are excited about what Australia has given us in terms of opportunity. So if we continue to handle the way things are, that dwelling deficiency is going to hit us at some point. And no doubt during this point, I'm not here to talk about my bias. I've talked to you about areas that will decline. And I know that there are pockets that are declining. I've picked up properties 10% cheaper over the last few weeks in some areas too. But then there's also markets showing stability and slight uptick. So I think the key here is, investing has long-term wealth creation. There is a dwelling deficiency happening at some point in the next 2 to 3 years. Believe that. That's not a prediction. You can see it. Like approvals in a pipeline is not a prediction. Approvals in a pipeline is a fact. And then on top of that, it all just depends on when the airport opens up and how we handle COVID, based on how much population will start coming in, as well as if we decide to do any visa changes. I strongly feel Australia should consider the impact of overseas migration slowing down. I think it's not been talked about enough. 60% of our population growth in the country was that. So when you really think about it, then our fertility rate from 2.1 has come down to about 1.6, 1.7. We're going to be losing people if we don't focus on overseas migration. And obviously, it's always about bringing the right people in who line with Australia's values and so forth. But at the end of the day, with aging population, it hasn't been talked about much in terms of the global and the Australian news space, migration impact. If we don't open up the doors, or if we don't open up the visa scenarios and loosen some things here and there, then that's a cause for concern. But I think now, when that opens up, we are headed towards a dwelling deficiency. But I just think it's been kicked down the road further because of COVID. So it might, instead of being 2021, it may go to 2022 to show itself. And that's my thoughts of what's happening ahead.
And obviously a reduction in supply and increase in demand does have a flow-on impact on prices, which means that eventually those prices will go up again.
Yeah, 100%. And that's where V-shape, U-shape, for it to be any shape like one of those two, it needs to drop. But then V-shape means it comes back fast, and U-shape means after a bit of flat, it comes back fast later. So the consensus is, whether it's a V-shape or a U-shape, it's one of those two. And for it to be one of those two, we are going to see some pockets have those impact, some decline. I'm seeing it already. It's just a matter of, where stable growth, decline, distress, there's going to be that. And to be honest, even before COVID, there was that. Like, people have had problems for decades. People have to sell for decades, centuries. There might be more that show up in some pockets.
That's right.
True that.
Perfect. Well, thank you so much for your time and your insights. Learned a lot, as always.
Heads go back into the book straight after this to study more.
That's it. We'll be sharing that again for the next round. Perfect. Thank you. See ya. Bye-bye.